Do you have questions about your real estate portfolio? Are you wondering if those should be put into a corporation or alternatively keep holding those personally? If you do, then this is the podcast for you. On this episode, we're going to be looking at the ways to move that property into a corporation, the impacts that's going to have as far as taxes go, and then some ways that you could potentially pay less tax on that rental income once you've moved those properties into a corporation. So without further ado, let's get right into it. Welcome to episode 47 of the Tax Talk podcast. Your host, as usual, Jared Pallon. And what are we looking at today? Everything you need to know about a corporate real estate portfolio. So I know that the biggest questions that are coming into our firm on a regular basis are people inquiring about what they should do with their real estate portfolio. Should I hold it personally? Should I move it into a corporation? What are the benefits? What are the drawbacks? I know this is a pressing question for people right across the country as we receive inquiries from all different provinces looking at the implications to them and their personal situation based on what it is that they want to do going forward with their real estate portfolio. So I want to get all of this out there in one episode and one corresponding blog post so you have all of the information at your fingertips to make the decision that is right for your situation. So, should you hold it personally or should you move that real estate into a corporation? Like most things that I tell my clients, it all depends. There are definitely some benefits to moving property into the corporation. There's also a number of drawbacks that you need to be concerned with. So let's look at the potential reasons that you might want to move those real estate properties into a corporation. First of which being liability protection. If you are getting into the business of owning a number of rental properties, whether you're holding those long-term or if you're just holding them and earning some quick turnaround income based on Airbnb or another hosting platform similar to that, people potentially need some liability protection in this regard. If something goes wrong at one of these properties, you may not necessarily want all of your remaining personal assets to be held up under that potential lawsuit. So it may be beneficial to move your real estate portfolio into a corporation to provide some separation from some of your other personal assets. Taxation benefits. Again, there are some potential benefits there that we're going to delve into a little bit further as we get into this podcast. But you need to kind of consider your long-term plans. Again, it becomes difficult based on the fact that the government continually changes rules and regulations without a whole lot of consultation, but there could be some potential benefits to having the properties in there if you're able to, move into the realm of creating a business for yourself with these particular properties. If you are planning to just hold one real estate investment property, no plans to grow that portfolio beyond that, you may not benefit from moving that particular property into a corporation for tax purposes. So, how does it work then? Maybe you've got a property or two, you're thinking, maybe it's time to move these into a corporation. Maybe I'd like to see some liability protection out of this. And maybe there are some potential tax benefits down the road. So what do I have to do to move that property into a corporation? So first off, we need to determine what the fair market value of that property is. Don't necessarily need to go to the extent of getting a third-party real estate appraisal done on it. If we're moving it from your personal name into a corporation, it's largely an internal reorganization of this piece of property, and using a recent tax assessment from whatever city that property is located in would likely be sufficient for this purposes. If you do proceed with moving that piece of property into that corporation, within that rollover agreement, which we will discuss here, is a price adjustment clause that you would want to include there to give yourself some protection with respect to that fair market value that you have pegged on that building should CRA ever come back and challenge that value. So what is this rollover provision that we're talking about? So typically speaking, if you were to move the building from yourself personally into a corporation, that would be a deemed taxable event. If you have an accrued gain on that building, that is going to result in potential taxation to you. So what can you do alternatively to avoid the taxation on that transfer? You can conduct a rollover via Section 85 of the Income Tax Act, which allows you to transfer that property into a corporation, providing you abide by all of the set out rules that underline that particular portion of the Income Tax Act. This will then allow you to move that property into the corporation without any negative tax implications at that time. You will then simply be deferring the accrued gain that you have at that particular point in time into the corporation to a point in time that you eventually do end up selling that property at that juncture. Probably, from my opinion, the biggest items that you need to discuss in regards to the transfer of that property into the corporation are not necessarily the legal or the tax side of things. To me, those are quite simple. It's easy to speak with a lawyer and get a land titles changed. It's easy to speak with us here at Legacy Accounting and get a rollover agreement put into place and the necessary election done with CRA. To me, the most important things to get under control and have a grasp on before you proceed with anything is understanding what the land transfer tax would be on that applicable building and the transfer of the same into the corporation. And then if you're subject to a mortgage at this particular point in time, if your lender is going to allow you to move that mortgage into a corporation. As you are well aware, an individual and a corporation are separate legal entities, so there may be some difficulties in moving that mortgage into a corporation, especially if that corporation was just newly set up. It likely has no credit whatsoever. You may be able to work with the lender to set up some sort of personal guarantee on there and be able to flow that mortgage in there. But again, you would want to speak to them about that. There may be some potential cancellation fees that would apply to that as well, because you are moving the mortgage out of your personal name and into the corporation. So it's important to understand those two particular items well before you consider any of the legal or tax implications. It's quite easy, again, to speak with a lawyer, get a corporation set up, and then take the necessary legal and tax steps to move that property into the corporation. But you just want to ensure that you've got some of those other items tied up beforehand to ensure you're not putting the horse before the cart in that respect. Moving forward, the other item that I always want to kind of mention is just the GST implications on a transfer of property. So if you hold a residential property, typically speaking, used residential is not GSTable. So you're not going to have to worry about that. If you hold a commercial building that you are renting out, you are likely going to need to factor that into the particular transfer that you're moving forward on. So what typically you would want to do Again, meeting all those other requirements first with your lender, get that corporation set up, ensure that a GST number is put into place within that corporation, and then you would be able to move that building from yourself into the corporation and then do what is called a self-assessment on your next filed GST return in respect to that building. And essentially what you're doing is based on that fair market value that you determined earlier, you calculate the GST on that, and you effectively report that as an in and an out on the GST return. That is the reporting requirement with CRA. It's not going to impact you cash flow wise, but it is important to get that onto that applicable GST return for reporting purposes. So now that we've moved the particular property or multiple properties into a corporation, how does the taxation work on my rental income? So what ends up happening with passive income, and we'll list off Alberta rates, is if you have passive income in your corporation that you leave behind, i.e. you're not taking it out as a dividend to yourself as a shareholder, you're going to be looking at corporate tax and a combined rate of 46 2/3%. What ends up happening then, if you pay out the profits from that particular operation, you would then have a refundable portion on the federal side, which is equal to 30%. So effectively what happens when you've paid out the profits from that rental business, you're going to be looking at a combined taxation rate in the province of Alberta of 16%. So in comparison to the small business rates of 11%, it's not a huge spread once you've paid those profits out. But what you have to be concerned about with is if you're moving this property into the corporation with the intentions of building a real estate portfolio going forward, you're going to be wanting to leave the excess cash in there, and therefore you're going to be either subject to the higher rate, 46 2/3, or you're going to have to pay yourself dividends on a regular basis, pay the corresponding personal tax, and then take that money and stick it back into the corporation. So as a result, typically speaking, like I mentioned before, it's not overly beneficial if you just have one property for a taxation side of things to put that into the corporation and try and grow from that point in time. It becomes very difficult cash flow wise unless you're heavily depreciating the buildings that are associated with those properties to see any significant cash flow in that corporation that isn't taxed at a fairly high rate. So typically what I would advise clients, if you're just getting started out, hold that first property, even the second, the third in your personal name. Ensure that this is something that you essentially want to do as a lifelong means of, building wealth, building a potential pension into your retirement years, and building, some legacy assets that you can then transfer on to the next generation. Spend that first little bit, hold those first couple of properties personally, and then at that point in time, once you start to accumulate things and grow them to a certain extent where you might be able to benefit from some other, structuring within that corporation and therefore some more effective tax rates, at that stage, then you could move those properties into a corporation and allow for some more effective tax rates at that juncture. Again, like lots of people wonder, can I do that? You can affect that rollover provision at any point in time. So it's very much easier to start out holding those properties personally and then building to the point where it does make sense then to hold them within a corporation, as opposed to starting off the hop, putting one property into a corporation and then for whatever reason deciding maybe this isn't for me, and wanting to get that property out of the corporation to avoid the additional, admin, accounting, and legal fees associated with holding a corporation. It's much more difficult to get assets out of a corporation than it is to put them in down the road via that rollover provision. So we've got the properties in here. We've got a bit of a business going. We're trying to kind of move ourselves then away from what CRA says is passive rental income. We want to get ourselves classified as an active business. So instead of just collecting a rent check on a monthly basis, paying some utilities, and basically doing nothing beyond that, you want to be involved on a regular basis and be more hands-on. This would enable you to then, therefore, take advantage of those small business tax rates of 11% without the need of paying any profits out to yourself personally. You're then able to generate much better cash flow and keep building upon that real estate portfolio. So how do you go about doing this? You need to have 6 or more full-time employees on staff within that corporation. That then moves you into what CRA deems as an active business. So you're probably thinking, how am I ever going to get this done? Well, it's not honestly as hard as it might seem. You could find a handyman/repair guy that can do some work for you. There's one employee. You can have some administrative staff that does, bookkeeping, invoicing, paying payables, things of that nature. You can hire someone on to do some marketing for you. There's constantly turnover in the properties, especially if you have a number of doors and you're putting these through Airbnb. Having some regular marketing for these properties would be super beneficial in respect to that. You probably need someone to do some property management things, managing the contractors that are in and out of the building, handling complaints from tenants, doing, some of the other repair work that maybe the handyman can't do. And then, just someone to do general security as well. Again, some of these might, require you to have a number of properties to justify having someone on payroll for them. But when you start thinking a little bit creatively, there's ways to kind of start making some of these things work. It's important to find the services that you're paying for externally and try and internalize those particular services as best as possible. You'll need to ensure, again, to have these employees on payroll. Therefore, you're issuing T4s to them on an annual basis. You'll need to ensure you are making regular monthly payroll remittances and withholding the proper, source deductions. It would be wise to look into WCB, have some liability coverage for these individuals, taking the necessary steps to protect yourself in regards to the fact that you're having some employees on staff as opposed to just hiring some general contractors. So this is a fairly simple way when you start building that portfolio out to start moving it from passively held income to more of an active business. And it's probably significantly easier to make that case then too if you have, multiple properties and you're renting them out on a short-term basis through an Airbnb or something similar. You're providing, regular cleaning services, things of that nature. It's much easier to make a case that you are operating a business, much in respect of what a hotel does. Those would be classified as an active business. They have, clients coming in and out of there on a regular basis. They're providing security, cleaning services, meals, things of this nature. If you can kind of niche yourself into that area as well, then you have a strong case for classifying yourself as an active business operation as opposed to just a passive real estate corporation that collects rents on a monthly basis. So this is basically the conversation in a nutshell. How you can, grow that real estate portfolio. What are some of the benefits of having it in there? How you can move it forward and effectively take advantage of some of the lower tax rates as a result of it. So when you're planning your real estate portfolio, I find that it's very important to speak with an accountant early on in the process. It's much easier to get yourself, straight from the beginning, get everything in line in respect to, the ownership status, the understanding of the taxation, and getting those, foundational pieces put into place from the onset, as opposed to what some people do when they come in here. They've completely forgotten that they have to report rental income and expenses, or, they haven't kept track of receipts. Just general things like this will put you behind the 8 ball and make things a little bit more difficult in respect to, taking care of your basic tax compliance issues, but more so being able to understand what it takes to, operate that real estate property. And ultimately, if you have plans to, grow that portfolio, putting a system in place that kind of captures, the revenue and expenses from each property. You can see where things are profitable. You can understand how costs are accounted for, whether they're a current cost, i.e., a repair on your building versus a capital cost when you're doing some sort of, major renovation and improving the, the livelihood or the usefulness of that particular property. So important to speak, with us at Legacy Accounting early on when you're kind of starting out, ensuring that you get onto the right foot. Again, then speaking with a lawyer if you're planning to, move into that incorporated world, and then having those general discussions with your banker, understanding if there's any, transfer tax on moving things into the corporation as well. Getting all of the basics out on the table, putting that plan in place, beginning, at the start is going to be super beneficial for you in the long term. So if you have any additional questions on this particular topic, feel free to touch base with me, Jared, Jared, at legacyllp.ca. I'd be happy to schedule a quick call with you to go through some of your more detailed questions on this. Again, like I mentioned from the onset, every situation is dependent upon the individual that I talk to. What might make sense for one individual or family might be a horrible plan for someone else. So it's important to speak with me early on in the process. I can help you kind of get navigated in the right direction and ensure that you understand the options that are available to you, and then make the decision that is probably the most simple from the onset, but that leaves you with some availability to do some different things down the road, dependent upon where things go in respect to that real estate portfolio that you're looking to build. So I hope this was hugely helpful in regards to your questions along holding a real estate portfolio within a corporation. I enjoyed bringing the information to you and look forward to chatting with you on the next episode. So for Legacy Accounting and the Tax Talk podcast, once again, your host, Jared Pallon. Thank you again for listening, and look forward to seeing you on the next episode. Take care.